the stocks which are having high premiums so that we can buy them at low and then sell them at high. So there is a lot of interest in the SOFI. So I wanted to go and see that how SOFI could be traded. So the first step in here is to look into the SOFI stock and then see what kind of information we can get about the stock, right? So this is the stock. You can see that today it is down, and there are a few things that we can go back to here. If you click up in here, it's gonna show you some of the information. So for example, if you like to look back, say in 1 year's time, this is how this stock look like. You could also make it do a candle chart. So this is currently trading under the 20 days moving average, which is the mid part of the Bollinger Band. So it can be a good opportunity to buy, as you can see from here, from RSI also, which is 41. So if it is below to near 30, it will be oversold. And if it goes above or near 70, gonna be overbought. So there is a good possibility that it can bounce back after this point. So what are the particular information that we should be looking at? For example, if I look at 25-ish, it can be good buy point, or you can also look back into 25.8 or little less, say 24.5 or 25.2. So these are the things that we can look back into here. So one of the things that we would like to look back into this is in this particular wheel strategy, we should be looking at the stocks which are bullish. For example, one of the signs of the bullishness is that the price is on rise, and you can see that if you put a trend line in here, it's gonna be a rising. That means that every time as the time passes by, the stock price tend to move up. So this is the good sign for a stock to be traded. So what makes SOFI so attractive in here in terms of the buying and selling? One of the things that we have to look into here is the IV. And let me take you to the IV and then explain it here. What does it mean in here? If I click up in here, trade, and then if you go to the, in this particular case, if I go back to this particular stock here, SOFI, and if I click up in here called trade options, right? So we will be teaching the first type, which is to do in terms of the options. So you could actually create your own builder in here. So if I just take you here, then these are the two steps of the wheel strategy. One is to buy them, so through the cash secured put, and then we sell them through a covered call after we purchase, right? So these are the two steps that we would be looking into. So if we go back and then look into how we can go this. So for example, if I click up in here, and if I say, okay, I want to go, say, cash secure put, and then if I go there, then these are the current stock price. Now, the first step in here is to look back into what kind of period that you're looking for. There could be a number of periods that you could be looking at it. One of the periods that you should be looking at it is the days that you would like to look back. For example, 11 days or 10 days and so on and so forth. So let's go back and then see, let's say in the case of 11 days. So this is the share price. Now, what you're going to do, you will go a little bit out of the money in here and see what kind of deltas that you can look back. So simply the delta stands for this, that how the movement of the this particular contract, which you are looking to buy at 25, would be impacted by the change in the price of the stock itself, which is trading at 26.51. So how do you do this? We will be looking into this particular delta item. And then another important parameter to look at the open interest. What is an open interest in it? So let me quickly take you to, for example, look at to this particular entity. If you go there, you can see that there is an open interest, right? And there are a few other things that you have to look at. For example, employed volatility. So market expects there could be a bigger price changes move, and the higher the price changes move anticipated, the higher the employed volatility. And for the same matter, the premium could be higher. So what is the premium? We can get it somewhere between, for each share, 0.38 cents to 0.41 cents. Now, if you look at the delta, as I explained to you, that's about 25. So 75% chance that you will win it. So just opposite of that number is 0.75, and hence there is a chance. Another thing that is to be looked at in here is this gamma. That means that how much this delta keep changing. So how is the change or the rate of change in gamma, in delta in here. So what we're going to do in this particular case, we will see like this is a velocity and this is an acceleration in terms of the speed, right? So this is the way that the prices are changing, and this is how prices changes are accelerated by this. And the other parameter is data, which is to look at what is the time decay. The higher, the better it is. So what should be looking at it? For example, if you are an option buyer, in this case, cash secure put, your job is to look at the higher the theta, the better it is for you, right? There are two other parameters which is not very relevant for this particular context, but the two other parameters, the delta, you should be trying to aim between, say, zero point 0.2 to zero point 0.3. Sometimes you can go a little bit higher, but then lower the better. But it will be a compromise to your premium. On the other hand, we have this gamma value. So the lower the better it is also. Okay. So what we can look at here, the lower the better, the lower the better in the case of gamma, and the higher the better for the theta. However, the lower you go, your premium should be dropped. For example, if I click up in here, I'm gonna see this. So it is very likely that if I put up say 10 contracts, right? So this is the highly likelihood of fill up, but if I just put it say 40, it will be a low likelihood of put up. So usually the Robinhood gives you a price ballparks that you should put them so that it can be filled immediately. But the moment you do this, it's gonna give you say $379, and it's gonna, if you look at you here, it will charge you for the lockup of the price, which is 25 times this particular 1,000 shares you're buying, because each contract contains 100 shares and 10 contracts stands for 1,000 shares. So you would be paying $25,000. So this is what it says in here. If I go there, it says that, yeah, that's about this number. You can see this. And in order to break even, that means that you bought, suppose it is being assigned to you, your break-even price is $24.62. That means that you will be buying this at a discount if it is assigned to you. So we're gonna be looking into at